How much is this course? Like I'm already like I'm ready to take the like if I was learning like I would be I'm ready. You've already sold me. You're
Yeah.
detailed, you're exact in your science. Your methodology is
Yes.
unbelievable. Like I'm already
Thank
sold.
you.
And I didn't even know you had a course when we started
Yeah.
talking this stuff. Everybody, I have so it's Matthew Hawkins, right? It's Matt Hawkins.
Yeah.
Do you go
Yeah.
by
Everyone
Matt?
calls me. Yeah, you can call me Matt, and the big thing is we're branded as Lumberjack Landlord
I see that.
because
Lumberjack Landlord.
yeah, I worked in corporate for 27 years,
Okay.
and so they had basically banished somebody previously for having a side thing like this.
Hmm.
And so I was, for the 3 years I did this channel when I was still working, I was the Lumberjack Landlord. You couldn't find my real name anywhere.
Yeah, and you don't even have a picture of yourself on your thing, do you? Like,
That's why it was, no,
I,
that's why it was a
I was
character.
a little surprised to see a real person. I didn't know if I was going
Yeah.
to be talking to an
Yeah.
animated version of you today or not.
Yeah.
But tell us a little bit about where you're from. You can tell us how old you are if you want, when you started investing in real estate, and what kind of real estate you're doing now and have.
Sure. So, great to be with you. So from New Hampshire, we have 17 miles of the most beautiful coastline you'll ever find. And certainly it costs that much too. Yeah, so I've been investing since, since right around 2000. So got started in high tech in 1998. I'm a ninth grade dropout. So anybody in any room is more educated than I am, but I still did it and built something. But yeah, ninth grade dropout and just started with odd jobs and then got into technology in a telemarketing department and then worked in tech and then lost a bunch of money in the dot-com bomb.
Wow.
And so I said, wow, I don't like this at all. This is a horrible way to invest your money and watch it all go poof just based on people's feelings and valuations and all this other silly stuff. So to me, it was kind of a fake world and I wasn't planning on moving to Manhattan. So I was never going to be in those insider parties where they talk about, guess what just happened with XYZ company. So the thing that made the most sense for me was I needed to find an asset that I could purchase that would then create revenue for me. But hey, it'd be awesome if it also increased in value. And so really there's very few things that fit that, billing, and real estate was one of them. And so I started looking at real estate, started investing in real estate. My very first deal was a house hack. I was doing it before they even had a name for it.
Mm-hmm.
And so I did that in 2002 and rented out one of the rooms to a roommate because I was solving a problem. I said to the mortgage rep, because he said, you don't qualify. I said, how do I qualify?
Mm-hmm.
He goes, you need to make more money. I go, how much more money? He's like, a lot more money. I go, that's not going to work. So I reached out to my friends and said, hey, who wants to live in this area? And so one of them was like, yeah, I'll live there. And so I signed him up for a lease for $1,000 a month. And that was the difference between my being able to buy the place and not being able to buy the place.
Wow.
So I got him on a lease. He moved in and that was my very first deal.
That's all.
Yeah, it was fun. And
How
then,
old
so
were
I-
you then? How old were you then?
20, 23,
Okay.
22, 23.
Yep.
Yeah, pretty young. And so, yeah, that was right around the dot-com bomb. And then realized, hey, this really kind of works. But I was focused on my career. And I was just like, but it still afforded me to buy this place. And so then I went to go sell that place. And the reason why I'll never buy a condo with an HOA is because I got hit with a $70,000 assessment.
Wow.
Yeah.
I don't buy any with HOAs either.
Mm-mm. HOA, condos, nope, hard pass. So did that, got hit with a $70,000 assessment. Thankfully, the property had gone up enough where I could still sell it with an agent and still actually walk away with just a tiny bit. So I did that, bought another house hacked that, and then I started buying multifamily. And and that was all early 2000s. I was one of the unfortunate ones who couldn't find an agent to give me a liar loan. So I was actually buying stuff with 20% down and buying stuff that cash flowed.
I didn't know I didn't know that there was a name for that. The liar loan.
Yeah. Liar loans or ninjas. It was no income, no job, no assets. They called them ninjas. And so those liar loans were awful.
Yeah.
And you could literally, it was just, and the reason why they were awful was because all you had to do was say your income. You could say 400K.
Yeah. Stated
Didn't
income.
matter.
Yeah, it was a mess.
Stated income. That's all that mattered. So people were buying things they obviously couldn't afford. 51% of mortgages in 05 and 06, 51% of those mortgages were adjustable rate mortgages.
Yep.
Well, after 2 years, they adjusted. No one could afford them.
Yep.
Because they had their liar loans based on creating a liar payment. And then they couldn't keep up because all of that had gone away.
Yep.
So that's why we start seeing the great financial crisis. And thankfully I made it through. But Fannie Freddie changed one of the main core rules, which was they took it from, you could have 10 mortgages in your name to 4.
Yeah.
I already had 5. I was done.
You were done.
Unless I could find another way to invest. And the way that I started investing everything was every year I would find a property that I could rehab. I would buy it. I'd renovate it myself.
Okay.
I'd live in my rehab. And then at the end of the year, I'd be done. And then I would do a cash out refi and I'd go into the next one. And I did that 9 times in 13 years.
Okay.
So, and then we find ourselves today with 53 buildings, 150 units or so, and 400 tenants. And I self-manage, and I teach people how to self-manage their portfolio like a lean, mean, elite managing machine.
So so when you say you manage, does that mean you have your own management company?
I'm me. I'm it.
You're the guy.
I am. I'm it.
I
love it when people ask to speak with my boss. I'm like, sure, just a second. And I come back on the phone. Hi. Your employee's being really rude to me. I was like, yeah, we talk to him about that all the time.
So how many doors do you have right now? Did you say
150?
150. And they cash flow decently because you manage and you're running them like a tight, well-oiled machine, I'm assuming.
Yeah, I mean, no one's going to run my business as well as I will, right? I mean, that's just what we know, that when we give control to somebody else, we know that liberties will be taken.
Yes.
It won't be run as well. But yeah, I mean, our worst performing asset's probably 17%.
Oh, wow.
Yeah. Our worst one, our best ones are in the 50s and 60s.
Gotcha. So
yeah.
How are you acquiring? So let me rephrase that. So just to let you know a little bit about what I've been doing.
Please.
I started wanting to buy houses about the same time, 2002, 2004. I got out of college in 98 from Penn State. I was a wrestler at Penn State. I was a captain. Got into wanting to buy real estate. I got up to about 29 properties, and then 2008 happened, and that was a mess because we were real estate agents and builders, and the economy went to crap real quick, right?
Yep.
So we started a real estate team. We built a big real estate team selling, and then we also started buying at the same time. We used private money. So my brother found a guy that had private money, and he would give us $1 million, $1.5 million, and we would buy houses, in our town, like for $30,000 and $50,000. $50,000 for a 2. I think I paid $35,000 for a 2-unit once. I bought a house for $15,000 once and rented it out for $600.
That's awesome.
I went to our private money guy and I said, Denny, are we buying too many properties? Are we going to get in trouble here? He says, Rob, when you can buy houses cheaper than cars, you buy all you can.
Yes, sir.
So
yes, sir.
That's what we did. We bought 100 that one year, and
awesome.
Then we got into raising capital and doing some bigger deals. So right now we're sitting at about 800 units of real estate. I will say the 200 units that we manage by ourselves, it might make $12,000 a month. Not a lot for 200 units, but when you talk about full management and full place, full construction, it funds everything within it, and it has for a long time.
Sure.
But if I were to stop what I'm doing and go hyper focus on those 200, I probably could double that, or I probably could triple that.
Easily.
I could triple.
Probably triple it pretty
Yep.
easily.
But I wouldn't be able to do the other stuff that I'm doing. So there's a catch
Correct.
22, right?
Correct.
We went on and have a lot more units. The equity pay down across the board is unbelievable.
Sure.
550 of the units are raised capital, so I own only a percentage of the deal.
Sure.
I do make $50,000 a month on those 550 that we literally pulled off the table in 2024. So that's pretty nice.
Awesome. Yeah, that's fantastic.
We also went on to build a 64-bed assisted living from the ground up.
Saw that. Very cool project.
Cool project.
Yeah.
Labor intensive, as far as building a brand, building the company to take care of seniors. We're doing a great job. We're pushing. We might be full by the end of the year. So
that's awesome.
Doesn't mean we're profitable. So that's a whole nother task. But we are. When you do a new business and new venture, you're learning all the way. So I could have scaled the way you did and just hyper focused. But I have a family, and we built a team and a company and good people around about operations. So we've just done it a little bit differently.
Yeah. No, I think that what I always talk about is right sizing. I was offered to do some syndications, and I was like, no, thanks. And they're like, well, you get to do you're the syndicator. I was like, still no, thanks. I don't want other people's capital. I'm good. Small, humble. I'm good. And so that was the route that we wanted to go. That was just what kind of kept me going. And I like taking an asset and turning it around, so our goal wasn't hyper focus for growth. It was hyper focus for the next deal, and then doing another great deal, and then we'll follow that up with another great deal.
I was on the phone with a friend that used to be in the Collective Genius of mine, and he has like 40 rentals, class A, and that's his focus. He does one thing and does it really good.
Exactly.
There's a lot to be said about that. Now, I will say, because we pushed and grew, we bought a 20 unit once. We didn't have the down money to buy it, so we used someone else's money.
Sure.
We owned it for 7 years, sold the 20 unit after 7 years, and we each walked away with $430,000. Not a bad deal when you couldn't afford to buy it at the time.
No, totally agree. Yeah, we've taken some, we've taken some capital, but it was very specific to a specific deal, and we never did equity partners. It was only we're taking your cash. And that's when banks didn't want to lend. But now you do kind of flip that point. And so now I've written products for banks, where I've shown them, hey, this is the way you need to structure this product to get more investors to use your bank.
Yeah.
So I've written product, and I've used that product. I'll eat my own dog food. But 30-year fixed rate debt on 1, 2, 3, and 4 unit buildings. And for me, I've got bigger stuff, but I like the 1 through 4s because it's attainable for everybody right from the get-go.
Yeah.
Right from the jump, you can do a owner-occupied house hack 4 unit and usually live for free.
Yep.
And do it again in another year. And then you can get owner-based debt as opposed to investor-based debt.
Yep.
So, people just follow that path, and within 5 to 7 years, you're going to have $1 million worth net worth easily.
Yep.
Pretty easily. You just have to be willing to, I don't really want to move every year. Well, I didn't want to. I was willing to do what it took to get rich. Like, that's it. That was the goal. The goal was, okay, we did a cool project. What did we learn? Great. We learned these things. Now let's take that on and do the next one, and we'll do it better. So yeah, I don't know.
Were you married? Were you married during any of this time?
When I started in 2002, I wasn't. I got married in 2007. So that was the conversation we had on our second date.
Yeah.
I said, hey, just FYI, I'm a real estate investor. She's like, well, no, you're not. You work for a software company. I go, real estate investor. And I said, that's my path to get out of this thing. I'm not going to be, some 50-year-old or 60-year-old sales rep. Not doing that. And I said, and I want to, I want to have something that is far more passive and that allows me to build and kind of do things my own way. And so we had that discussion on our second date, and we knew at the end of our second date that we were going to get married, and she knew that we were going to be a real estate investment family. That's it. And now we've been married for we've been together for 20 years. We've been married for 17, coming up on 18.
How many times did you have her move in the first couple of years?
Every year.
Every
Every year
year.
she moved. So, 07, 08, 09, 11. Yeah, she moved out of those 9. I think she moved 6 of them.
I tell you what, and young people, right? Young people's problem is they want everything. They want the 2-car garage, the nice house, and all that stuff right away. And you obviously sacrificed and pushed off all of that for time and time and time, right?
Sure. Yeah, I still to this day I drive an '06 Yukon.
Wow.
I could walk in and I could buy a Lamborghini tomorrow and write a check, but that's not the point.
I had a Lamborghini on my goal board for years until they went to 500,000 or 600 or $800,000. And I'm like, I'm out. I'm out.
Yeah, you're like, I can't look myself in the mirror and not have bought another building with that.
When they're 300 grand, I think I would have bought a new one, but now they've just gone off the charts.
They've gone insane. And so the stuff that, I've always had fun cars. But I'm just a value investor. Everything that I buy, whether it's a car or a building, it has to be value based. It has to be, what is this really worth and how much of a deal am I getting?
Does that ever change when the cash flow gets big enough or the net worth gets bigger? Does that ever change?
I never share net worth, but it's pretty massive in all honesty. Because I paid down a lot of properties. I purposely portfolio deals with banks that had 8 or 9 or 10 buildings in them.
Mm-hmm.
And then I get them to discharge the debt on certain buildings. And so I still carry the same size note, but I would start off as an example. I'd start a portfolio loan that had 10 buildings in it. And now 4 years later, it only has 6 buildings in it. And I've gotten the bank to give me 4 of those buildings.
Wow.
So that's a strategy that not really many people understand. They certainly don't know they don't know, their bank's not going to tell them how to do it. But that's a strategy that everyone can use. It's just a matter of agreeing what the terms are going to be on the portfolio, which is, let's say it's 70% LTV. And I show them every year. I say, great, we can pay for another set of appraisals. And that might cost a couple $1,000, $3,000-$4,000. We get the appraisals done, and then the number comes in at, let's say $5 million, and I say, hey, I've got $5 million, but I only have $3 million in debt. So let's just discharge assets until we get down to the point where we're, $4.2 million. So we hit that 70% loan to value.
Yep.
I got $800,000 worth of assets you can discharge to me right now.
Yeah.
So I get those assets for free, and then I either sell them and 1031 into something else.
Yep.
Which is a non-taxable event. Or I just re-lever it with debt to then go shopping for more, or then just have that much more sitting in reserves.
I get it. So the last 2 years, have you bought many assets in the last 2 years? Because I tell you, I have not bought any, with the exception of the last 6 months. Hold on. Oh, I haven't bought a whole lot of stuff in the last 2 years.
We've kind of taken it easy. I think this year we've bought 3 or 4, and I think last year we bought 2 or 3. So we haven't been crazy. We've bought, like I said, 6 or 7 in the last couple of years.
Yeah. So it's been a little slower than previous years, correct?
Yeah, we stepped up. I mean, people can't do math. And so in 20 and 21, when I could get 3.5% debt and the pricing was about the same or maybe 10% higher.
Yeah.
I was using girl math. I was on a shopping spree. Like, put my wife to shame. I think we bought 23 or 24 deals in 17 months.
Yep.
But they were all buy and holds, nothing to flip. It was all buy and hold stuff where we saw the longer term strategic direction. But then locked in at sub 4 rates, 4 and less. I think 85 to 90% of my portfolio is debt at 4 or less. And it's all 30-year fixed rate debt.
That's pretty amazing. I can't say mine's all 30 fixed. A lot of it's 30 years, but it's 7 to 10 years, some of it. So
yeah,
that's great.
And that's the challenge, right? You see the stuff that's going to blow up in the next couple of years. It's the guys that took 3 and 5 year debt.
Yep.
Or you got Ben Mala who took 0-year debt. Is he going to blow up? No, but he's lost tens of millions of dollars in the deals that he's done because he basically didn't want to fix the debt because he was borrowing it at 1. and he was buying something that was a 6 return. So he was, 5% on 1% money. He was, 5x his money. So
Who is that again? Who is that again?
That's Ben Mala. He's a big investor down in Florida. He a big commercial guy.
Yeah.
He's done strip malls and hotels and hospitality and all that sort of stuff.
That doesn't sound too good.
He's an awesome investor, really super dynamic guy. And I think that he does it right to a degree. I think the only mistake that he made was just not fixing that debt. Because he had 1% debt, but he could have fixed it at 2.
Yeah, he did.
Or 2.25, at least for 5 years. I would have fixed it. And so that's the stuff that we're seeing now that's coming on that's distressed because they bought it in 20 or 21. It had 3-year debt.
Yep.
And now it's coming available, and it had 3.5 or 3.75 debt, and now it's got 7.75 or 8.5 debt.
Yep.
And shockingly, it doesn't cash flow anymore.
Well, I'll run by one. So 6 months ago, we bought 24 doors in our local town, relationship based. My brother knew the seller, and they worked out a deal of $2 million purchase price in our town, so we can self-manage real easily with our management company. My brother negotiated $0 down.
Yep.
We got 6% interest only for 5 years, and then he got 15 years, 6% interest on a 30-year AM. So we have 20 years of financing.
Beautiful.
And we were able to cost seg it, and we brought over 60 grand from the tax account. So we pre-funded the operating account, and we're about 4 or 5 months in, even doing some major turns to get rents higher. We are still making $2 to $3 grand a month on this one little deal. So seller financing, are you doing any of that with any sellers? And to us, it's a great tool.
Yeah, I mean, like the way that I always position it with sellers is it's basically you still get a monthly payment like rent, but you don't have to fix any termites, toilets, or tenants. So if you like the cash flow of being a landlord,
yeah,
the answer is always yes. And if you like that there's nothing on the expense side of the balance sheet, the answer is always yes. And then you don't have to take any more calls anymore because you get to be a mini Bank of America. The answer is yes. So yeah, we've done a lot of seller finance deals where we've done my best seller finance deal is at 2.5%.
For how long?
30 years.
The whole 30.
Mm-hmm. It's when debt was like 3.5.
Oh,
debt was 3.5. And so I just said to them, I said, listen, I can get bank debt for 3.5. I said, I'll pay your price.
Yeah.
Which in their eyes was the mountaintop because they'd paid a third of that price, 15 years ago.
Yeah.
But to them, that was the mountaintop. And they're like, yeah, we want to get that number. I was like, the only thing that you have to do to get that number is agree to 2.5%.
Did you put any money down?
10 points. That's it.
Okay. That's not too bad.
It was small. Yeah, no, it's small. I mean, anytime I can get out of a deal for less than 25% down, then it makes it a non-standard deal, right? Banks want to see 25, 30, 35, depending on the asset. So anytime I can get into a deal for less than 10%, or 10% or less is a huge win. And then it's just a matter of how low I can get that interest rate.
Yep.
So we just did another one at 5% for 15. And then basically I said, but you'd want that to continue. I said, and if that payment continues, then you would get to, then I would get to exercise and basically go to then current rates and, continue at that then current rate. But at 15 years, that property is probably pretty close to pay off.
Did you put a max on that? Because I did that once and then put a max, like I capped it at like 7 or something like that on a deal.
Yeah, we didn't cap it because, with only based on the size of the deal, size was only, maybe $500,000.
Oh, okay.
So it wasn't crazy big. So it was one of those things where it's like, yeah, you know what? Sure. If rates are 16, then we'll just write a check and pay off the rest of this, but we'll be 15 years in. And we did a 30-year AM, but the biggest value in that deal was, the landlord said, well, yeah, we rent them out as 2 units or 2 bedrooms. And I said, oh, okay. And I was saying it that way because I looked it up and they were 3-bedroom units.
Mm.
And so I was like, so why do you do that? And he said, we just found that we got better tenants when it was 2 bedrooms instead of 3 bedrooms. Oh, okay. And so I said, all right, that sounds good. And then even for a 2-bedroom, they were 60% of what Section 8 pays.
Yeah.
And so I asked him, I said, so how do you do rent increases? He goes, oh, no, I don't do those. Oh, okay. Interesting. So he hadn't done a rent increase in a decade, you know? So we bought a building that they were renting for around 11 to $1,200 a month, and they're worth 22 a month.
They were rented for how much a month? 1,100?
11 to 12, yeah.
And they're worth 2,200.
22, yeah.
Wow. How long did it take you to make the transition?
So we've transitioned one of the units. We're not one of those we're kind of like slow is smooth and smooth is fast.
Yes.
So we like slow, which is, hey, tell us what's wrong with your unit. And we're going to fix it up while they're in it.
Yeah.
And then we talk about, okay, cool. We've kind of done everything on your list. Hey, we want to let you know that in the next, what do you think is a fair price for rental for your unit?
Mm-hmm.
So we use my buddy's strategy called the binder strategy from Dion Talk Financial Freedom. He's got a great thing called a binder strategy where we do it all via text. We basically send them something and say, hey, it's been great having you as a tenant. How do you find all the updates and repairs that we've made? They write back, hey, we love it. It's great. Thank you so much. It's amazing. We say, sounds awesome. Well, we want to just give you a heads up. Here are 3 or 4 units that are comparable to yours in the local market. And so we'd love to keep you as a tenant because we also want to see if there's any idiots in there, if there's any idiot tenants.
Yeah.
And so it gives us some time to assess that. And so then we make them the offer of, if they're good tenants, we make them the offer and say, hey, here's 3 or 4 units from your local area. They're basically like units for you.
Yeah.
Here's their pricing. Let me know what you think would be a fair price for your unit because we do have to raise the rents based on increased water costs, increased taxes, increased labor, increased maintenance.
Mm-hmm.
The number has to be greater than where we are today. And they actually like that process. And, we just did that with some units and they were at 1,100 and the guy came back and said, I see everything is like 19, 2,000, 2,100 bucks. And he came back and he said, would you do 1,800? And I said, sure.
Good.
He goes, really? I go, yeah, of course. I know he's a good tenant. I know he doesn't complain. I know he's not unreasonable when something breaks. He's not like, why are you not here? It's been 7 minutes. So when they're a good tenant and they don't complain, and complaining isn't like raising an issue. Yeah. It's how you are when that issue arises.
Yeah.
Are you calling me every 30 minutes because you broke the handle on your cabinet? Like, call me every 30 minutes when it's a water problem. Don't call me every 30 minutes. But I'm going to be there before your second call.
Yeah.
So when we looked at it, we get good tenants that like the place and they recognize they're getting a deal because they're not informed. They didn't shop around, but they realize they're getting a great deal. So we let them stay for 1,800. And for us, that was $7,000 a month times 12 months is $8,400. We made $8,400 more on just that one unit in that triplex.
That's amazing.
And that goes all to the bottom line. None of that gets left behind. So yeah, we're always looking for those value assets. And so that's the part that's the most broken about me is no matter how much money I get, no matter how much money I'm worth on a balance sheet, it all comes down to where can we create more value?
That's awesome. We are ironically working on another 24 unit, different from the one that I mentioned. This is at a college town. We own a 72 unit. We don't rent to college, but we have another 24 unit that we found off market from our marketing from 2 years ago. It just came back into the pipeline.
Awesome.
And they gave us a price of $1.6 million, $66K a door. Rent $66K a door, needs carpet, paint, that kind of stuff to make the units more modern. But they're, they have, they have the stairwells where you walk up and there's like 4 on each level. So there's two buildings of 12. So it's really nice apartments. They have balconies out the back and $66K a door. You can't build them for that, No. And my brother I sent my brother cause I was at the Collective Genius and, we offered terms. We said $200K down, 6% interest, and 3 years. We only need 3 years till we get rents turned around. We know we knew he wouldn't go for a long-term play just based on what the knowledge we knew in advance. And he tried to go for 2 years, and he came back to 3 years. And instead of 8% interest, which he wanted, we negotiated to 6.5% for interest only for 3 years. So, but the cost to purchase the basis is really good. So we know once we get the rents up, we will be able to go to. Do you do any Freddie or Fannie type loans with any of yours, or no?
So I did, but on purpose I maxed those out. I maxed them out on purpose.
No, the small,
the large stuff.
large.
No.
Okay.
No, none of the large big stuff. No, I mean, so we've looked at that, but we like to bring that to a bank only because we want them to continue to give us sweetheart deals on the small stuff.
Yeah.
You know, when the economy goes boom, it's tough to move a 12 to 24 door asset.
Yeah.
When the economy adjusts, it's not hard to move a 2 to 4 asset because you can still do owner occ, and you open up the doors for all sorts of opportunities where Fannie and Freddie will fund that at 5% down payment. You can get down payment assistance for 3 or 3.5%. So you're literally able to walk to the table and buy something for 1.5 points out of pocket. And if you're a veteran, it's 0.
Yeah.
So you can't do that on the big stuff. And so for me, I always consider what my exit is, and having that diversification within the portfolio where we've got, 80% small assets and 20% big assets, it really gives us flexibility on if we ever decide that we see one thing moving differently or moving in a negative fashion, where we say, okay, now it's time to cash out of that and pour into the other side because we see that over the next 5 years, that's going to do really well.
Yeah.
I sold out of I had some commercial mixed use buildings. I sold out of them. And what was really funny is I actually became the bank on them.
Oh, wow.
I became the bank. I got 8-year debt at 5, 5, and 5, which is a 5% 5-year prepay. So they pay 5% if they want to get out of the deal in the first 5 years, and they're locked in at 8%.
Oh, wow.
I'm thrilled to give them 8% money. Absolutely thrilled.
Being the bank is the next level stuff probably down the road.
I think so. I think you'll find the same thing when you start to liquidate some of your assets. It doesn't make sense to sell them outright. It makes sense to find, get some stuff paid off and maybe move some stuff around and then be the bank on some stuff because, those notes are assets. So we've got a couple of properties where we have the note on them. And so those notes are assets and they pay at 8%, which anybody would love to get 8% rate of return.
Yeah. Oh, yeah.
Guaranteed, and own the underlying asset for about 65% of its value. Like that's really valuable debt.
Yeah, extremely.
So we do those with some some of the private bank stuff where we become the bank. We do the seller finance stuff. We've done a deal kind of every way.
How are you getting 30? Are you getting 30-year bank money on new deals you do now? And how?
I wrote the product for the bank.
A local bank.
Mm-hmm.
Wow.
Yep. I can show you how to do it. Super easy.
Okay. I might have to get I'll reach out to you to get your email to get some information on that. Cause I have a local bank that does anything we want to do. They're phenomenal. We have unsecured lines of credit with them, like 2 million unsecured. Not, if we buy a house, they'll put the lien on it after I buy it.
Yeah. I think that, and that's where, you're a good investor. And that's when you have a powerful and quality relationship. The thing is that, get the most out of that relationship. And so one of the things that we did was we started looking at, kind of dissecting and saying, okay, the big banks, the big 5, they don't give 2 rips about the community. They don't care.
No,
they're not, they got a location there is what they have.
Yep.
But we started targeting banks that were under 2 billion AUM, assets under management.
Yeah.
We started targeting banks that were that size. And then after we started targeting banks that were that size, we started to look at, they had between 3 and 7 locations.
Mm-hmm.
We wanted to understand what their lending profile was. And how do you do that? You do a loan with them.
Yep.
So we did loans with 4 or 5 of the local banks. Went through the pain of that because you have to provide all the documentation and paperwork, and it's not just, hey, it's Matt the Lumberjack Landlord, I'm here to get some of your money now. It's more of a process, but you go through it, you get approved, and then you understand what their process is. And then we learned to start calling the senior lender. The senior lender in these banks is the one who makes the decision of rate. He's the one who evaluates the portfolio with the CEO that says, here's where our risk is in this portfolio and here's what our default rates are. And so we would work with the senior lender, and we worked with our VP that was our portfolio manager at the bank. So we worked with basically them to put together, I put together a 5-slide presentation and said, here's the value to the bank.
Yeah.
Is that these are local investors. It's in the community. It's of the community. It's for the community, which fits your charter to a T. And the only thing that we're looking for is 30-year fixed rate debt. That's it. That's all we're looking for. We'll give you the deposits because the mother's milk of a bank is deposits.
Yep.
So we'll keep the security deposits in your bank. We'll give you all of the deposit flow from those assets.
Mm-hmm.
And all we ask in return is that you make it a 30-year fix, not a 5-year arm or a 7-year arm or a 10-year arm.
That's great. I'm gonna definitely ask you for this slideshow and give it a shot.
Yeah. So we did millions of dollars of those kinds of loans. So
and you're still getting them today.
Yep.
Wow. Now, tell me you're not the maintenance guy either, are you?
I got some scars on my hands. You see all these scars.
Do you have some employees that help you out on your 150 units?
So we have one employee.
One. Wow.
Yep. One. And the job that he really took over was I came from a background of software.
Yes.
And so we've leveraged our software properly to fully automate the business.
Wow. That's great.
So a tenant, their rent is automatically collected. Their phone calls are automatically received. There is a typed out message from their voice message, so we can see exactly what the problem is. And it goes into a queue that's managed and monitored by 4 different people. And then you know which one's your responsibility. And then they give a call and go out and they handle it.
And obviously you use HVAC and plumbing and flooring guys, right? Probably do painters use painters then as well.
Yep. Yeah. We use all the trades. The thing that we really have is, there's no painting that's an emergency. There's no HVAC that's necessarily emergency. It's much more like, the plumber / HVAC service guy. It's the, if it's a property maintenance thing, like a leak or something like that we know who that goes to. And then if there was some like electrical issue, it can still be the maintenance guy because he can just say, hey, shut off the breaker.
Yeah.
Type of thing. So it's really kind of built, creating the business where it's only 3 people, maybe 4 people. I'm CC'd, so I'm not one of the people that has to go out and do anything. Sometimes we do, but very rarely. And it's usually because, my one employee is traveling or on a family thing.
Is this your own software that you're using?
Nope. We actually made it to work with any software.
Oh, wow.
Works with any product out there. And really what it is, so the software world that I came from, something called best in breed.
Mm-hmm.
And so best in breed concept is you don't pick one system that does everything.
Yeah.
You pick the best of each product at that thing. And so we have one system, which is our core management system, but then we have maintenance, and we basically just attach that ticket system and that call-in system to our property management system, which is DoorLoop. But DoorLoop's a decent product, but, frankly speaking, building them kind of sucks. AppFolio is pretty good.
That's what we use for all of ours.
AppFolio is really good. That's like one of our top 2.
But then what do you use for the maintenance then? DoorLoop?
Yeah, well, so we use DoorLoop for everything because you can do a lot of things in there. But when you're talking about like somebody making a phone call,
yeah,
we set up everything where we have, they can in DoorLoop, they can set a ticket,
mm-hmm.
but they can on a maintenance line, they can call in. And the way that we set that up is it's a phone number that goes into a voicemail box. It does transcription.
Mm-hmm.
And then we can have that transcription upload into DoorLoop. Or we can actually just have the guys that monitor that box, and then they can just cut and paste and put that into DoorLoop as a ticket.
Oh, wow. I may have my asset manager reach out to you at some point.
I'm happy to help.
Just for a quick discussion, maybe on some of that stuff. So it's, I don't, if I write it down and want to learn it right now, right, it doesn't help me because I am not in charge. I don't take a phone call. I haven't been to my properties. I drive by them if I see them, but it's easier for me to look at the larger properties than it is the smaller ones.
Yeah, we're just, I think one of the sayings I came up with early on is people do what's inspected, not expected.
Yes.
And so with having a really small staff, I still like to go out in the field, not do any work anymore. Not really. Like I'll do an emergency thing. But I like to go out and I like to see the properties, ask questions, hey, what's going on with this? What's happening with that? And so, I meet with my guy once a week and just kind of go through things and say, hey, this is what I saw go into the portal. I saw all these things be addressed on the in the portal. I saw that we had these calls come in and there's always that turn of winter, right? Like the last 2 weeks have been crazy nuts busy.
Yep.
But we'll settle down in the next week. It was nice to not get our first cold spurt during Christmas.
Yeah.
Because then you're going to be busy Christmas week. But yeah.
So that's your superpower, right? Is this the way you've managed this whole system? Plus, of course, being able to figure out the buying process. That's your two things, huh?
Yeah, and then, just managing an asset, how to get the absolute most out of an asset. We believe in three steps to that process, which is acquisition, stabilization, and optimization.
Okay. So
it's about, hey, how do you acquire? And I don't care how you acquire, wholesale, retail, off market, on market, seller financing, from a foreclosure, from a short sale. I bought from a tax lien. I bought every way possible. And so we've bought every possible way. Now the next step is, how do I stabilize this unit, get it rented to the right tenant, and then make my list of these are the improvements I want to make over the next 2 or 3 years. And then optimize the unit where now it's not just stabilized and I have a good tenant, but now I'm optimizing it and I'm dragging down the cost of managing the unit and thus increasing its profitability.
Wow.
And there's tons of stuff that you can do there. I mean, that's why, I've got a course and it's about 10 hours long. And then we do a boot camp that's about 30 hours long. But when people finish my course, guess what? They are pretty good. They're a lot better than they were.
So who is this course directed at again? Is it the first time person or?
So we've had people as few as 0 rentals.
Okay.
So they don't have any bad habits yet.
Okay.
Unless they've taken another course, then we kind of have to smack their hand and go, no, don't do it that way. But there's a lot of good courses out there that kind of teach some of the fundamentals. But the key is, how do you become an elite operator, whether you're having to actually operate the portfolio or you're managing a property management company that's operating your portfolio?
Oh, okay. Yeah.
Because, 40% of people use a property manager, 60% don't. And usually the 60% that don't, it's because they're so small that they don't need one yet.
Yeah.
And so if we can teach people, this is how you become elite. Here's how you acquire. Here's how you stabilize. Here's how you optimize. Now you're making the most money you possibly can with that asset. It's more valuable to the bank. It's more valuable to you. And you have much lower vacancy and much better turnover. I haven't gone over a 1% vacancy rate in 7 years.
Wow.
Not over 1%. And that's because we create value within our units, but we manage any turnover that we're going to have and understand why it's turning over and then make those shifts and make those changes. But yeah, we kind of take people through all that process, teaching them this is how you manage a property manager path. And here's all the KPIs and metrics that you should be looking for from them. And then if you want to do it yourself, here's the way you do it yourself. And you just save yourself a lot more money.
What's your turn time? What's your turn time? The time it's vacant to the time it's ready to rent. What do you like to hit?
0 days.
You like 0 days.
I like 0 days.
We are not 0 days. We are in this 7 to 14 days. I mean, it's just hard with so many units to.
It is. And again, that was the choice that you have to make, right? Is that I can do 150 units basically at 0 days.
Yes.
Or you can do 800 units and you might have 2 weeks.
Yeah.
Well, okay, you got 800 units. That's kind of how it works.
Yeah.
The key to it is, kind of all of the dancing that we do before. It's the 60-day reach out. It's the, You have 3 weeks to kind of figure out if you're going to stay, if you're going to go, but let's talk about that. Let's make it a constructive move out if you're going to move. But managing all of those processes is really, I ran software companies. And so everything is people, process, and product.
Yeah.
And so the product I know is good, but we can always make it better. The people are the tenants. And so it's really about managing that expectation, and so when we're working through that process, we don't really very often have these surprises. So I have almost 5,000 tenant years. And the way that we count a tenant year is a person in a unit. Any adult in the unit is a tenant, and they're a tenant year if they're there for a year.
Okay.
So we have almost 5,000 tenant years, and we have 12 evictions in 23 years.
Wow.
Yeah. No one touches.
Okay. So how much is this course? Like I'm ready to take if I was learning, I'm ready. You've already sold me. You're detailed. You're exact in your science. Your methodology is unbelievable. Yes. Like I'm already sold, and I didn't even know you had a course when we started talking this. So how much is the course? How long does it take? That kind of stuff.
Great question. So
I own 800 rentals, and I think I need the course.
There's no doubt that you would. That course will probably pay for itself within 2 weeks for you.
Wow.
No joke. Within 2 weeks. I'd be shocked if it didn't. We only charge, and I know the number's unreasonable. It's $1,000.
$1,000 course.
That's it. Because the reason why was I didn't want to be all those $97, $297 guys. Because what I want people that are really ready to take the business seriously. And you're not going to spend $1,000 on something you're not serious about.
Yeah.
So if they invest that $1,000, that gets them access to basically 10 hours of pre-recorded training.
Okay.
And then they get access to the community and all the assets that we provide. We provide move-in, move-out checklists and timing of getting a tenant out and timing of getting a tenant in and all of that workflow and process stuff that landlords rarely do very well. So bigger guys like you guys absolutely have that process in. There's no doubt in my mind you guys have that dialed in. I'm probably not going to teach you anything there, but there's other areas where we can say, hey, these are things that need to be making sure that are happening beforehand and that you have a transition to your tenants.
Yeah.
So it's not a bunch of heavy lifting the first 5 days they move in. I had 3 people move in this last weekend. I've gotten 1 email. That's it. And that was with the person that I send to meet them not even being there. I said to her, I go, you might be at risk of not having a job, honestly. And she started laughing. I go, I'm not joking. I was like, the system's that good now. You weren't even needed. You were gone. You keep on taking vacation. But
well, I'll put it this way. I didn't get any emails last weekend about a tenant moving in.
And that's exactly right. That's one of those things where for me, that's normally handled by them. But when people go on vacation, I have the systems and processes where I can jump right in and just know, hey, she's on vacation for the weekend. I got it. No problem. I don't need to give it to somebody else. And because for me, that's overhead. And I like seeing, massive returns. The second piece of the course is the boot camp. We have a lot of people that jump in the boot camp, and they'll do it when they have an active project. They'll do it when they're rehabbing a house. They'll do it when they're just like, the market's going to shift it's going to continue to shift a lot over the next 12 to 24 months.
Yep.
I got to make sure that I am set up with all the processes and work that I need to do to make sure that I lose as little money as possible.
Yep.
And that's what a lot of people are all about, the increase of capital and not about capital preservation. And very often you can get that increase of capital if you understand capital preservation.
Yeah.
And so, and we do the same thing for that boot camp. It's $1,000. It's 12 weeks long. It's 2 to 3 hours every week. So you get out of there with 36 hours. Trust me, I'm not in this to make money.
Yeah.
You can do the math on how little that means I'm getting paid for my time.
It's not live, is it, or anything like that?
No. Well, it's live with me, but it's behind it. It's only those that we allow in the boot camp.
Okay.
They pay, but we limit it to 15 because we want to be very real and specifically speak to items that are pertinent to those people in the course.
Okay. Yeah. I think we're
So
definitely
we would-
interested in the first part. I think we would maybe catch some things we're missing. We do a lot of detailed stuff. I don't even know what we do, but I can just tell by talking to you that we should be looking into it.
Yeah, I mean, so again, I mean, I think what you did is awesome. When I had the choice to do what you did or do what I did, I felt less comfortable doing what you do. I was just like, it's big and there's a lot of moving parts and there's always a big next deal and seller and all that stuff is awesome. For me, I was just like, I was still working a W-2, so I had to KISS method it. I had to keep it simple, stupid, make it really super easy, have processes for everything.
Yep.
And that's what helped me be a good executive, a good executive for a software company.
Yeah, I never went to W-2. I just started self-employed, so I had no choice.
Awesome.
And I had 2 brothers and a couple
Had to go
wives.
big.
We have families involved, so it helps.
Yeah.
The bigger you can spread it out more. So
Heck yeah, I would never do anything with my family, so good for you.
family-owned, family dealings since 1998. We're all here. No divorces, no major fights in the last. Once you start making more money, the fights become less. So
Yeah, they do. It's a fight about where you're vacationing.
yeah,
Not we can't afford to do X.
yes. Well,
Yeah,
I'm gonna have Ryan get with you to make sure we put a link in the comments below for all your coaching stuff.
Oh, cool.
And
Yeah.
we greatly appreciate it, and I learned a lot today. You're top notch. Now I have a real person to put to that picture that I see on your Facebook. So
Yes.
let's keep in touch, and I appreciate your time.
Rob, it was a blast. Love doing this with you. If I can help you out in any way, I'm happy to do it.
Okay, thank you. We'll see you.
Appreciate it, Rob.